my letter to the industry was a love letter to like my love letter to laundry of why we are making, it's not a $140 million investment in cents. It's a $140 million bet on the industry and our customers. And nobody had made a bet anything close to that historically.
All right, everybody, welcome to the Start to Scale podcast. I am super excited about today's guest. His name is Alex Jekowski. He is the founder and CEO of Sense, but he's also been a multi-time founder of another company called, is it called Ulingo?
Ulingo, yeah.
Ulingo.
Yeah.
So serial entrepreneur, raised almost $250 million in the past 6 years. But Alex, if you can let our listeners know a little bit more about yourself, that'd be fantastic.
Yeah, thanks so much for having me on, and I'm excited to chat. Sense is my second business, is similar to my co-founder. It's definitely a little easier after you've been through the trenches first time round. But my first business was in the higher ed space. I was in college and saw pin boards all over the place and thought that was just an insane way of passing along information. Every single college seemed to be the same. And the idea was to create a digital version of that focused on classified and marketplace related things. I think a lot of college students see like a Facebook free and for sale and all that kind of stuff. And eventually that pivoted into a payment system we sold to college campuses. So you go to marketplace.vanderbilt.edu, log in with your student ID, and we would facilitate the payments for what we called student life commerce. Could be membership dues, meal plans, peer-to-peer exchanges, event tickets, et cetera. Everything around student life, essentially integrated with all the campus systems. Ran that for about 5.5, 6 years. Left school to go full time on the business my sophomore year, and then ended up selling it in 2019. And during that exit, was thinking about, okay, well, I got to work at the parent company for 3 years, had big earnout, but what am I going to do to scratch the itch of entrepreneurship? And long story short, heard about laundromats and thought about maybe owning some stores, and thought that'd be a fun way to just invest in, like I said, scratch the founder itch, the business owner, roll up your sleeves, get to do stuff while you're an executive at another company. And the deeper I got into that industry, the more I fell in love with it, and the more kind of, holy crap, this is insane. But I also don't know how you run these businesses the way that they run today, which is you could buy a brand new store with brand new equipment and brand new everything, and coin is still your predominant form of payment. And there's not like industry specific software or anything to run the business. And so in 2021, ended up leaving the parent company and went full time on Sense, raised our seed round, and boom, here we are.
Amazing. Yeah. And that's interesting because I feel like back around 2019, 2020 was around the time when everyone started going all on demand with everything. So like Uber Eats, all those on demand apps started blowing up. And I think even with laundromat and kind of the laundromat business, it started to kind of serendipitously growing back in 2020, 2021. So go ahead.
No, as you say, it's 100%. That's why all the venture capital dollars in laundry went to delivery businesses and the Uber for laundry. A lot of people didn't realize that all the Uber for laundry businesses, where were they taking the actual laundry that they were picking up? Laundromats. They tried to do the facilities themselves, could never do it. And it didn't make the economics of it didn't make any sense to just have a plant somewhere very far out of the city, all the logistics infrastructure when there are stores all around the actual customer sending out the laundry. And so the laundromats have always been the backbone, but all the, 2019, 2020, even before, it was how do we create the Uber for X and how do we be a brand associated? And I think there wasn't the love and affection for the small business owner who's actually powering a lot of the work. And that's where you've seen, I think, a lot of things flip in the world of vertical AI and vertical SaaS and SMB tech, is realizing that the anchor of these industries are the small business owners that power.
Percent. The backbone of America, they say, are the small business owners. But yeah, just kind of go back to when you were younger. Did you always want to be an entrepreneur?
I don't think so. I don't necessarily want to be an entrepreneur now. I think it's not like a desire I necessarily have. I think it's a mix of not having any hard skills, probably. And I just enjoy this kind of stuff. I don't think when I was younger, I thought about that. I mean, I had my own baseball coaching company, but it wasn't because I wanted to be an entrepreneur. It's because I liked baseball. I loved coaching. And I bought a batting cage and pitching machine with my bar mitzvah money and loved to like coach, kids when I was in high school. And so but it wasn't like here, and, I make a business plan, but it wasn't of the endeavor of, I don't want to have any other career. I just want to be doing this. So I think I use the quote of kind of Uri Levin a lot from the founder of Waze. He says, fall in love with the problem, not the solution. And I think I do find those things really interesting. And I like kind of doing things and challenging the way that things are done and call it the status quo. It's one of our kind of guiding behaviors here at Sense, which is question the way things are done. It doesn't mean that question will lead to the right answer, but the exercise of questioning why have we been doing it this way is a driver for what leads to a lot of innovation. So, I love what I do. I love doing this. I love building things. I love supporting customers. I love having a team and seeing the team and individuals grow. But I think the desire to be an entrepreneur leads people down, I think, in sometimes inauthentic and we can lead people to a lot of mistakes because they want to build a business so badly. They don't actually care about the product that they're building or the solution they're truly solving. They just really want to be the founder, if that makes sense.
No, 100%. I think a lot of founders or a lot of aspiring entrepreneurs glorify that founder lifestyle of, being the CEO, traveling, being your own boss, managing your own time. When in reality, it's a lot of very unsexy, hard things that you're consistently doing, growing the business. To go back to Chapman, you're a university student, you're founding Duolingo. How did you kind of get the foundation to start a startup and also the credibility to start a startup, as a freshman or sophomore at university in Chapman?
I mean, I don't think I got any credibility for it while I was doing it. I think, look, the same message I have, and I jokingly tell our board at times, but it's like every day is something I haven't done before. You haven't raised $250 million until you've raised $250 million, right? You have to do everything the first time once. And I think in building the first business, there were I think mentorship and advisors were very meaningful, and ones that beat the crap out of you, in terms of being honest and authentic in their feedback and holding a certain bar of quality. So I think the thing that Chapman did the best for me was kind of advisor and mentorship pairing. And that been through the course of my life in every business. I have hit up as many people, gotten as many beers, coffees, and everything in between, phone calls, Zooms with as many smart people as possible, to absorb as much information. Because the only reason I know, what I should be doing now is I've learned enough from people that have done it already. And then you figure it out as you go. I think we did, for every one thing right, did 100 things wrong in the first business. And incrementally, you get better and better. But I'd say that the thing that really was tremendous was kind of the advisor mentorship of just successful entrepreneurs that had seen around the corners and could tell you foundationally and fundamentally what makes great businesses. There's a stat that in the last 30 years, there hasn't been an increase in the survival rate of companies. And I think that's generally because anybody can give you the blueprint on how somebody went from point A to point B in their business. But every industry, every product, every culture, every company, every founder, whoever it is different. Nothing is a copy and paste. At least has not been my experience. Every time we try to copy what somebody else has done, it doesn't end up working. But we can take the elements of what made Toast successful and Olo and Slice and Jobber and Built and all these great companies, take elements, and then we have to do them our way. And so I think, learning from Chapman and being a college student and then leaving school and doing it on my own, I'd say it was just like you fail enough times to start to learn how not to fail as frequently. I think the other side was finding an incredible partner. I started at Chapman as a solo founder, and it wasn't until I left school, moved to San Francisco, I ended up meeting my co-founder, who's our now SVP of engineering at Sense, and he transformed the business. So quality of mentorship, advisorship, and a willingness to fail frequently, and to learn and be like hungry for that to get better, and then finding incredible co-founders and partners is how you build maybe the mix of credibility or enough experience to weather the adversities that come.
What are kind of some ways that you found these incredible advisors and that you found these incredible, co-founders and folks in your C-suite? And what are kind of the qualities that you look for when you're finding these folks?
I think in the beginning at Chapman, it was just a pairing. And I just got lucky, I think, or maybe I presented and then they paired me with somebody. Interestingly enough, I think I rarely have any quality advisor that either tells me what to do or tells me what I'm doing is right. I think that you constantly, the quality for me in the beginning of the business is like, I had some pretty brutal ones in terms of the way they get feedback. There was no gloves on to try to make me feel better on how it was being delivered. There were a lot of painful realizations. I think those are probably the most impactful early on. Uh, so I think on the quality advisor, you have to know what works well for you. Like I like when people are brutally honest with me and can beat the crap out of me when it comes to giving me the feedback. So that I know from the data that's a valuable resource for me, but I need to be able to engage and challenge them back and have that argument, because that makes me better when I can hear their perspective and dig deeper and deeper. In terms of how do I find advisors, I think one, if you are out there wanting to engage with people, the most successful people really do want to engage back. I have the people that give the least. So in my experience in business, maybe not in the world, the ones that give the least, the ones that have done the least. The ones that have done the most are excited and willing to give in terms of their experience, information, advice, but they want to know that you care about their feedback and their advice, and you have to search for it. And so I think I don't believe in NDAs from the perspective of let me tell you my idea, because you have to believe that your idea, your execution of your idea is better than somebody else's execution of your same concept. And so I was very open with what I wanted to build, why I wanted to build it, and see if anybody knew anybody in a similar industry who had success that would be willing to get on the phone. And so it's just a super high volume. And then I think the last piece is like, you gotta like talking to them. I don't have a single advisor that I don't want to get a beer with or spend meaningful amount of time with that I can really learn from. I think if you can't resonate with somebody, it's tough to listen to them when they tell you what to do to a certain extent. I mean, sometimes I struggled in school because it was hard for me to resonate and engage with my teachers at that same level. And in business, you have it's a different kind of opportunity to engage in that way. So those were things that helped me kind of early on and even to this day.
Amazing. And with Ulingo, what was the process of building that up to getting acquired and having that exit? What was the exit process like?
Yeah, I mean, I've never done it before. Didn't hire bankers, and we didn't have like venture capitalists on our board. It was, bootstrapped and angel funded largely. I think that we were going through that. We were trying to raise a Series A, and I didn't know what vertical SaaS was. I wasn't thinking our business was fintech. I thought it was a higher ed business, not a fintech payments business or vertical SaaS and education or any didn't think of anything like that. And so we met with higher ed investors, largely PE, small mid cap PE firms and some venture investors. And a lot of the feedback was like, look, it's a cool business. But if you raise capital, you get diluted more and more and more, then you end up selling most likely to one of our portfolio companies. Why kill yourself to have a similar outcome? And you should just talk to one of our portfolio companies to buy, to sell your business. And it was me and a handful of people, so it wasn't a big business. So I would just end up talking to a lot of the integration partners, other companies in the space and their CEOs. And one company was interested in doing a deal and we got pretty far with them. So then we alerted other companies that were competitors of theirs to say, hey, we might not be able to continue our partnership or integration with you, just as a heads up, because we're in the process of selling the business. And then a bunch of other folks came in and said, whoa, we're interested. Maybe there's something for us to do here. And so, we tried to index on the people that we liked the most and the business we thought could have the greatest outcome by doing more than just higher education, which is how we settled on a company called Moto Labs that bought our business and had a great dynamic with their CEO and their C-suite team. And they power not just higher ed, but kind of the mobile app infrastructure for workplace and colleges. And so we thought like that was a really cool application for our technology and our business, like the people. And that's how we ended up doing that deal. But again, there's so many times that deal almost died. And a lot of times that was painful experience. But you just kind of figure these things out as they go and try to get as much advice along the way as you can.
So a lot of, I'm the founder of a founder community, and a lot of our founders' goals is to have that exit or, to eventually build up towards an exit. And it looks like you had your first exit in your mid-20s. So how does it feel kind of accomplishing your first exit in your mid-20s, and what was that feeling that you had?
I mean, we sold the company on a Friday, and my first day of work at the new company was on Monday. So it wasn't like we didn't have it wasn't like, let's go on the world tour of enjoyment of the milestone. And I also think that, people say, oh, you want to sell your company. Well, then, okay, you want to sell your company, then what do you want to do? I like doing this stuff. And so I think the ambition isn't to sell. The ambition is to build, and build bigger and bigger and bigger. So I think look, it certainly helped from a fundraising standpoint for Sense and a learning and lessons. Everything when I started Sense, I did the exact opposite of how I started my first business. My first business as a solo founder, first thing with Sense was let's get some co-founders. First business, I went, left school, went all in, tried to do this. I tried to stay at the job and really establish product market fit before I thought this was a venture business. I wasn't 100% sure it was a venture business. We wanted to build as much as possible before raising really institutional capital, because we want to steward that capital in the right way. We want to be able to deliver a rate of return that a venture investor is looking at, and looking for. So, I think that it's definitely a fun experience. Don't get me wrong. To go through it and to feel proud of the team, with your team of the accomplishment, and have the little, drink celebration, et cetera. But it's whether you're raising 140 million, or you're selling your business, or you're raising a seed round of $1 million, or your first check of 20, my first check in Ulingo with an angel investor was $16,900. It feels very similar. Each milestone, it just leads you to the next one. So, for me, it's the exit, it doesn't really matter. It's what do you do for shareholders, and what do you get to keep building?
Got it. And now, transitioning over to Sense, you mentioned earlier you fell in love with that, on-demand laundry, space. How did, because a lot of founders that I talk to, they're in B2B SaaS, they want to do some type of, sexy industry like fintech or medtech or whatever it may be. How did you find yourself in the kind of this laundry on-demand space?
I think that what's critical is to understand foundationally like what you're good at. I've never been a Web3 crypto, what's the coolest and sexiest crap. That's just never been something in my life that I've been good at. I like getting very deep into things that I'm passionate and interested in. And so baseball was what I grew up loving. And so I didn't want to just play. I wanted to coach and understand it from every element. And that's why I started a baseball coaching business. It's because that's like it's fun and exciting and interesting to me. When I was going around college campuses, this concept of a pin board as a way to disseminate information and not being a college focused, digital medium for that was really interesting to me conceptually. And I think from a laundromat standpoint, I don't love garment care and repair. I don't like doing laundry. I wasn't born in a dryer. My parents don't own laundromats. It's not like this hero's journey. It's you meet business owners in a vertical that is super high performing. You realize that you could buy a couple stores and have 6 figures of free cash flow, hitting your pocket. And you think you could actually do that while doing other things. I just got excited about buying these stores. I see that so many times with our customers. They find out about the industry, realize how amazing it is, find a couple stores they buy, and they just become part of the laundromat community. And I would bet for one of our customers was a French fashion designer with like 50 retail stores across Paris, and sold the business, moved to Miami, and saw the P&L of a couple laundromats and got into it. If you asked him 20 years ago if he was going to be in the laundromat business, I think his answer would be no. And why the hell are you talking to me about that? So I think these are the things that you just kind of stumble upon, these amazing verticals and small businesses. And so, this became a byproduct of that. I think if a Sense had already existed, I would have wanted to buy laundromats, not build for them, in that same way. And so, I think that to me is the great founding story for so many businesses. You wanted to have something to either use in a business you wanted to apply, or you faced a pain point in your life and thought, why isn't there X? Let me build it. So that was kind of our journey here.
Wow. So there was back before 2021, there was no kind of all-in-one POS management system in the laundry space?
There were, family businesses, really small software businesses internationally that made a POS. Some family businesses that made on-machine hardware, about 3, 4 of them, and a handful of, 2, 3 POSs. Before that, none of them were all in one. None of them had a balance sheet to support growth. None of them had raised venture capital dollars. None of them were an all-in-one. None of them were trying to do more than just an awesome little point of sale for wash and fold, or for a laundromat, or an awesome payment system for self-serve, and that's it. And I think that's one of our big differentiators is we decided to take on a huge amount of risk by raising a lot of capital. But by doing so, we can move faster, more thoughtfully, and more from a customer first perspective because we have a balance sheet to back our shit up. We have the ability to say, we're going to build something. We're going to build it quickly. We're going to build it well. We've proved it and we have the resources to do it. And I think that's that's why investors get worried. I mean, I know for a fact that our competitors have had a tougher time if they've ever wanted to raise capital. It's a hell of a lot harder now because other investors know that we don't play around from an investment in this industry. When we raised our round of capital, our announcement wasn't a typical announcement. It was my letter to the industry was a love letter to my love letter to laundry of why we are making. It's not a $140 million investment in cents. It's a $140 million bet on the industry and our customers. And nobody had made a bet anything close to that historically.
That's incredible. So when you first started Sense and kind of to understand the industry, it sounds like to me you purchased a lot of laundromats in New York, and then you started building the technology to streamline all the operations for those laundromats.
So I was looking to buy stores, and I had met somebody who had been an industry kind of financing lender for a long time in the space, and he said, "Listen, if you want to build for the industry, you can't own any stores because if you own stores, then people are going to think that you're trying to compete with them by powering their businesses. So our thesis is always, we'll never own any stores as a company, me individually, or anything like that. We have employees that are laundromat owners because they help us kind of understand. They historically helped us really understand the business and the vertical. We got some feedback. Hey, you guys are just Silicon Valley tech guys. Like, you don't know what it means to be a laundromat owner. And obviously, I've been to more stores probably than each human on earth, I'm up there at least, and have worked more counters and spent more time in the industry than many. But there is some truth to the fact that having operators around the table is critical. So I never owned any stores. I had LOIs out. I wanted to buy stores, but the closer I got to trying to buy, the more I realized, holy crap, how are these things run at the level of which how I would want to run them? Because I have an earnout. I have a job. I can't be running around. I was living in San Francisco at the time. I can't be running around the city collecting quarters and checking on my stores while I have a 9 to 5 corporate gig. And that's what kind of led to building. So early days was understanding the industry, working in stores, going to events, talking to operators, realizing that building was probably better than buying from our standpoint on the stores front. Started building and going door to door to see who the hell would buy this thing. Is there product market fit, or is this just some idea I had and nobody really gives a crap about it?
And I feel like the laundry industry, is it fairly archaic? So when you're talking to your ICP, how adaptable are they with technology when you're telling them about your solution?
Yeah, I mean, I think a lot of people view laundromat owners, and I think SMBs in general, as unsophisticated, not willing to adapt to technology. But like, they don't have, you know, dial up internet and rotary phones. Like they're not remarkably sophisticated on technology all the time, but like, they want to have a better business. And they want to grow. Laundromat owners more than most are sophisticated because they didn't get into laundry because they love fashion and clothes. They did it because they love money and it's an investment. And they bought a laundromat to play more golf or spend more time with their family and not have to work a 9 to 5 job generally. So I'd say one of the reasons that they're not technically advanced is because there were very few technically advanced systems for them to engage in. And it actually is a remarkable feat for a lot of our operators of how sophisticated they were by Frankensteining 6 different systems, designing their own paper log tools, all these things to just be able to run their business. So there's definitely I'd say there was less of a technological fear that people had. It's I just spent $1 million on this store. I just took out another second mortgage. I bet my kids' college fund. This is a big investment for me. And who are you, young tech company, that's going to tell me you're going to power my entire business? How do I know you're going to be here in a couple of years when my note on my, my debt on my equipment is 10 years in length, my lease is 30 years? Like, who are you going to be 5 years from now, 2 years from now, 30 days from now? And so I think, in SMB, you have to earn the right for innovation. You have to be super thoughtful, genuine, deliberate, and transparent in how you're building, why you're building, and your staying power in the industry to build trust. our business has flourished when obviously our product is best in class and we're pricing correctly, but it's flourished when our operators trust us as a company the most. And I think that's true in most verticals, but particularly in the SMB.
So going to your, funding rounds, you started back in 2021, you raised your seed round. Uh, when you do your first tranche of funding and you get, a ton of capital coming in, what's your first, I guess, target, or how do you implement that capital once you have a tranche of funding?
Yeah, I mean, it's best laid plans. I think the early days is you're raising capital. You say what we're going to use it for. You have your pie chart and your financials that you're just dragging in, moving forward, that you're building yourself or with your partner who's not a CFO and not an FP&A leader and all that. We're just trying to figure it out. And what we cared most about in the early days was what is the underlying unit economics and what is the ARPU that we believe we can capture in the business model of hardware, software, and payments. And if we feel like that can be validated in our product market fit experience by getting, will customers pay X? Do their average stores process Y in GMV? And what do we think we can charge on hardware and software? We present that as the underlying model. And we think about what does it take from an investment standpoint to deliver on the product features that we've committed to customers. Most of our customers early days were betting on us. We would say we're the all-in-one system, but we had one of the 5 things that would go into an all-in-one system, right? So it really is they're taking the early days customers are buying something because it has value today, but they're taking a bet on what it will be in the future and the benefit that their business will have by having a say in our growth of product. So in the early days, it's raised, enough capital to build with some contingency left over of 20%, just to make sure that if things got delayed, if it didn't go as well, we didn't need to be rushing to raise capital in a distressed situation. And then we were in the time of 2021, where once we raised capital and made an announcement, I got flooded with C2, Series A, and we got super competitive. And then we raised the seed 2 round 6 months after our seed. And then we raised the Series A 9 months after the seed 2 round because the business was working. Nobody had done what we were doing really at the capacity in this space, and the access to capital from a cheap cost capital in 2021 was there, and it felt like we can raise a lot of capital even if we don't have like a perfect direct allocation for it. In a perfect world, we don't touch 50% of it. And a lot of great companies, Bessemer invested in Shopify, and I think $20 million never got touched. I was sitting in a bank account. I think that's, best case scenario, you raise the capital at the right times, where it can be efficient, but you don't need to touch it because you can really scale organically. In our business, because of hardware and software from an R&D standpoint, we really burned, we pushed. There are times we're burning $1 million a month, focusing on growing rooftops and even more than that as an early stage business. But we never got over our skis. Even after $25 million Series A, we didn't hire 200 people. We never had to do a riff. We didn't get there as a business, but we spent on R&D to position us at the point where we could do future M&A, where we could continue to build the business and grow. So I think early days capital raising is what do you need? Add some contingency to get to the next point where you're raising a true institutional round of capital. And then you have to be intellectually honest with how much venture capital can your business sustain to deliver the rate of return that an investor is looking for. Just continuing to raise and raise and raise just makes the noose tighter and tighter and tighter, and what your outcome has to be. If you raise at a $50 million valuation versus a $100 million valuation, the same investor is looking for you doubling the return. If they're looking for a 10x, it's the delta between selling at 500 and selling at $1 billion. And those are two very different numbers and very different buyers at those prices. And so, what we've tried to think about is how do we make investors money by utilizing this capital? And how do we deliver the best product to our customers, the best outcome to them without drowning through an ability to raise, if that makes sense.
That makes total sense. And as you're scaling from, maybe 5 employees to 10 employees, and I looked at LinkedIn, it looks like you have maybe 100, 150 employees. How do you find the right people? And then how do you structure the organization to make sure that's efficient as possible when you're overseeing so many folks?
Yeah, this is probably the most important thing that we've done as a company, is what we've invested the most of from a like capital and just time resource perspective. I think we have 98% employee retention. We've lost 3 employees that make over 100 grand, and 2 of them went to start a company together. We have extremely high retention of employee, and company culture has been paramount We have 90, we have like 94 people in the company today. And that includes, a handful from an acquisition that we had made. And we care very much about that $1 million of revenue per every one headcount. And we're pretty damn close to that number. From an efficiency standpoint, I think not many non the last 2 years AI businesses run at the revenue efficiency per employee that we run at. While also having 99% customer retention and like I said, around 98% employee retention. So this all comes down to, I think, the quality of the culture that we have. One of the best things we ever did that one of our, advisors instructed us or gave the advice to do is develop the guiding principles of our business, which is the framework of the character traits that make a sense employee, or as we call it internally, make a dime. To us, if you follow the guiding principles, if you embody the guiding principles, it could be act like an owner, run through walls, diversity in team culture and thought, stay curious, self-awareness, commitment to communication, a great responsibility, whatever of the 10. If you embody the 10 guiding principles, outside of some crazy HR violation, it's impossible to be fired. And that's generally because if you aren't succeeding, it's because we as a company have not put you in the right position to succeed because you have all the traits of a winner. And I think our mistake is we don't always hold the same bar of quality, but we always hold the same bar of values. And that has, I think, delivered an egoless environment where nobody is not willing to do any job. And I think that is universally true. There's very little finger pointing. And the execution quality becomes really high. But we also don't tell people that they have to work 60 hours a week. We would tell people early on, like, my goal is for you to work 9 to 5. Startups are hard. Things, you definitely have to work hard, not to say that they haven't, but I've had the most success in my career when I have the best work-life balance. But I'm also never not working, but I also care about enjoying my life. And I think we're pretty transparent with the entire company on that. So I think that we spend a ton of time learning, listening, and building on the corporate culture. But anybody listening who hasn't implemented it, developing guiding principles that are built into your recruiting and hiring process and are the talent evaluation rubric and framework, have delivered incredible results for us. And it's the lowest risk way of, in my view, building a culture of differentiated mindsets, backgrounds, et cetera, but universal alignment of what are the qualities of a true A player and winner.
Amazing. And as you're scaling, you mentioned you have around 98 employees. How do you structure do you have an all hands meeting, or how do you communicate with all your employees to make sure that, they are bringing in that million, per head count?
Yeah, I mean, we have, I think it's biweekly all hands, maybe monthly. But I think we do kind of our all hands meetings, and we'll do departmental reviews. I'll share a lot of the same information I shared during the board meeting. I mean, we're very transparent on the financials of business, what's going on. Part of that is we don't want anybody, nobody who gets fired should be surprised. And nobody who gets promoted should be surprised. I think people should know how well they are doing and how well the business is doing. In a spirit of cross-department collaboration between engineering and CS and finance and ops and all of those things. Better transparency and visualization of what are the priorities of these different departments is a huge element of that. And so we do our all hands, we do skip levels, we do an annual offsite every year that is, like, I set my clock to. I mean, it's the most amazing experience we have annually for the entire company. But I think from a transparency standpoint, a series I try to run with the company is, one of our guiding principles is act like an owner. And that is both act like the owner of a small business, think like our customers, these laundromat owners, but also act like an owner because everybody here is a shareholder. And so, theoretically, I work for the shareholders in the same way that as a CEO, these employees work for the executive, their executive reports. And so, the series I run is act like an owner and think like an investor. And so I want them to understand what's so critical about what we are doing for these small business owners and to have as much empathy for their pains and their success. But then I try to present our financials and our company metrics and performance in the same way that if they were an investor in the business, how I'd want them to be thinking about it. What are our risks? What is our value? How do we think about enterprise value generation? What is the value of different revenue streams? What does a miss in this month mean to our business? And how do we think about improving in the future? How do we identify false positives, false negatives? So we spent a lot of time on that. And I think it's been really helpful for a lot of our team.
Amazing. And what was the biggest surprise that you had raising $250 million?
I'd say how hard our Series B was, when in hindsight is the best thing we've ever done, because the Series B was tied to an acquisition of a hardware business called LaundryWorks. And I think it's very funny now. We hear so many investors talking about how incredibly important hardware is, because hardware is the connection of the physical to the digital world in the age of AI, when the SaaS apocalypse and all these SaaS companies are at risk because AI and Claude can just, anybody can build any product theoretically. But the world of we have hundreds of thousands of payment devices drilled into laundry equipment in the United States. And when we were raising our Series B, a lot of people said that hardware is dumb. And building hardware as a tech company, it's not a value revenue line. It's one-time revenue. It presents risk. It's not accretive on value. Why aren't we focusing those dollars on software? Why are we buying a hardware business when the world is software? And I think that it was so clear in my mind, in our team's mind, how important this deal was and how important the strategy of hardware was. And it was a surprise of how painful and difficult it was to get that deal across the line. And I was, passing the hat around, getting $25,000 checks at a time of a $40 million equity raise when we needed to. And all of those investors have done real well since that deal. But I think it shows that there are a lot of investors that get, you look on X right now or on LinkedIn, who are saying genius things, but not everything ages well. And so these genius investors and folks that pontificate on the world of startups have made mistakes and are imperfect, in the same way where great founders and great executives who build great businesses have downturns and make huge mistakes. So I think it was a surprise, as I hadn't seen a lot of these incredible investors be that wrong before. Maybe that's not the way to think about it, but I was surprised how challenging it was. And now also surprising how everybody has changed their tune in terms of how important the connection of hardware and software is, in today's world.
And typically, what do investors look for when look for in a founder and they're the C-suite of a company that they're investing in?
I think they want, it depends, right? I'm not super technical, and I'm pretty financially savvy, but I'm not a math whiz. And I can't I'm not doing my own modeling and things like that. But I think in my experience, on somebody who has more of my type of personality, I think they want somebody who's very genuine. I think the times where I've lost an investor is where I come off salesy or trying to convince somebody of something. So I think that, authenticity and being genuine, but remarkably passionate, goes a really long way. It's the one thing I can't turn off or on. I can't try to be passionate. I can't not. It is what it is. Like this, I love this business. I love doing this stuff. And so it comes out whether I want it to or not. But I think when you feel like you're selling, which you have to at times, during our Series B, I was selling my ass off, because you have to in what you're doing. But when you come off like a salesperson, you don't come off sophisticated. You don't come off genuine. You don't come off as a trusted partner. That's been my experience. I am a salesy kind of person, but I'm not trying to sell, and people know when I am. So I think that genuine, authentic, somebody that understands what it takes to win. Somebody who's just willing to do the things that most people would say are either too hard or too painful. Willing to take risks and willing to make a bet. I think somebody who can identify really great talent. Generally, no matter how much people like me, if they don't like my executive team, then they won't make the investment either. And we've had that, years ago. We've had that in the past where investors say, love you, love the business, unsure about the executive team if they can actually scale. We don't have that problem today, right? So I think that your ability to recruit and build a team, your ability to set a strategic vision, your ability to, passionately convey in an authentic and genuine, transparent way the path for a business's success From there, just don't be an asshole. But I think those are the three things that people care about, and that is universal at any scale.
Got it. And where is kind of what's your game plan for Sense now that you just raised the $140 billion Series C round? What are kind of your goals in the next, 1 to 5 years?
I think, look, we have a remarkable position in the market today, and we want to continue to support our customers in building badass products for them. So I think one is support. We're growing really, really quickly, and the value of support in a not just from an AI standpoint, but I think analog and personal engagement goes a really, really long way. So investing heavily in customer success to help customers actually understand our product line and all the things that we have available to them versus just saying, hey, sign up online, read a website, join a webinar, but actually being a little bit more high touch with them and being available from a support standpoint as our customer base grows, making sure support capacity grows. So we want to continue to dominate and build great product in the laundromat market. But we also are expanding into dry cleaning. We're also supporting the shared laundry rooms, RV parks, multifamily properties, colleges and universities, everywhere that laundry is done. We want to power those that do it. And so kind of increasing the serviceable addressable market without taking risk or sacrifice from our core base is critical for us. And I think just positioning the company for staying power of long-term scale is why we raised this capital. And look, part of the capital, a small part of it, was also an employee tender to let employees know that your stock actually has value. And being able to see some of our employees sell a small piece of their equity and be able to buy a house is, there's only one thing better than making money, and it's making other people money. And that is one of the better joys that you have when you're, particularly for the team that's in the trenches building and seeing the fruits of their labor kind of grow. So those are kind of our goals, and we just want to keep building and having fun.
I like the quote about it's not about making money, or it's about helping others make money. And you kind of look at, founders like Jeff Bezos or Gates or founders that have had tons of employees, but each one of those employees, their lives have been impacted very, very significantly from just working at an amazing company, um, that has scaled significantly. So I love that. Um, are you trying to eventually go public with Sense, or are you kind of are you going to try and keep it private, or what are your kind of goals with that?
Yeah, I mean, look, going public is just another financing event, right? It's not necessarily liquidity. It's you're raising capital and you're going that IPO route. And so I think that our strategy always been what is best for the customers, what can the industry sustain, and what is the best path for generating the greatest enterprise value for shareholders. So I can't say I've met a couple founders or CEOs that say going public is great, but I also have met a ton that say, oh my God, life is amazing now that we're public. It's generally a reason you go public. You've raised so much capital where preference stack is huge and you can't raise additional capital necessarily. So you want to go public and where shareholders need liquidity in some kind of standpoint. So I think that if we have a reason where we need to, then it makes sense. But I think the outcome for our business, what we try to build from a financial standpoint, is universal optionality in the kind of business we can build. I think we have the profile of a venture growth business, we have the efficiency of a private equity business, and we have the optionality of staying private and enjoying the cash flow the business can throw off of a strategic growth equity majority buyer, going public. I think the companies, my job is, in my view, part of my job is eliminating risk while maintaining upside. And so the more one dimensional or directional we make what our outcome has to be, the greater the risk of hitting that specific goal. And so we want to try to maintain our optionality at all times while still focusing on driving value.
Makes sense. Couple more questions. When you first launched in 2021, did you think that Sense was going to be this scalable?
I believe if you asked me in 2021 if I think Sense would be here, I would say yes. I just didn't know how we'd get here necessarily. So I think we've always had the belief that it could get to this level. That I think it would come after $250 million and 2 acquisitions. Not necessarily. Wasn't necessarily in our model. And do I think it would have been this challenging and difficult?
Shoot. Awesome. You're back. 1 sec. I think you're muted. I still can't hear you. Let me see. I still can't hear you. You can hear me though? You can hear me? Okay.
How's this? Is this any
There
different?
we go. Now I can hear you.
Okay, hold
Perfect.
on. Wait, so you can hear me?
I can hear you. I can hear you now.
Okay, good, 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 good. All right. Is the audio still good?
Yep. Audio sounds
Yeah,
good.
cool. All right. Sorry, sorry about that. That was crazy. I realized I had the wrong power plug into my computer and then just fucking died. So sorry about
No worries. No worries. I had one more question actually for you.
it. Hit me.
Uh, yeah. So maybe two more. First one is if you could tell your 21-year-old self at Chapman University when you're first starting your first startup, or actually, I guess you started the baseball coaching startup. If you can tell your younger self one word of advice, what would that be?
I think don't do things because you think they're supposed to be done that way. Or I remember being in college, like loving that I was at the office at 11 o'clock. And I thought that was cool because I thought that working hard and putting it on your Snapchat and posting about it and matters. And I think, I cared a little bit more about how I was viewed from an output perspective versus the quality of the output. And I think it was a little bit more ego driven and vanity driven, than anything else. And I would just say that none of that actually matters, and you end up enjoying it a lot more, when you're doing it for the right reasons. So I think it was kind of like this hustle porn. I remember Alex Ohanian called it, which is just like everybody loves to talk about how hard they work and how badass their stuff is, and how and their grind, and all the AI companies that are working 70 hours a week, and everybody's and I don't know. If that's what you love to do, then that's what you should do. If that's what the data tells you of your success metric and what builds great teams and longevity and all that. But again, the time I made so many sacrifices, but I made the wrong ones. I think that not spending time with my friends or family because I thought I had to do this thing when the quality of that work was rapidly diminishing. Um, and I wasn't being selective enough, but it just thought optically that's what I had to look like. I had to look like the person that was grinding, taking the phone call, doing the thing. And I think establishing a better balance of, self-care and enjoyment in your life, the impact of quality of work is so remarkable. And I think I probably experienced that more than anything else. So it's probably maybe not the best answer, but I think just trying to enjoy and finding happiness in everything you do at all times. Not to say that the hard work shouldn't be there, but focus on delivering happiness to your life. It's a great book by Tony Hsieh and his career arc in building companies, and how that has been the anchor of so many things, is finding happiness in what you do. Not saying it's easy, but finding the happiness in it and being able to look and love the people you do it with, the environment you're doing it in, and feeling lucky to be able to feel pain and work hard. I don't think I indexed on that very much in the beginning.
I think that's great advice. You also mentioned that employees generally work harder and better when they have a better work-life balance, when they're happier. I think when there's more stress, there's less mental bandwidth to really focus on their work. And so I think having that good work-life balance and enjoying all the little things in life really make people more productive in general. One more question. If you could tell an early stage founder any words of wisdom or advice, what would that be?
I I would say, focus on doing the hardest things. The easy things are like making a pretty looking website, not that hard. Calling a customer and getting them to buy your stuff, that's hard. Getting on a phone call with an investor, not hard. Doing the work of presenting information and compiling your decks and fine tuning every little piece of your VDR, that's hard. I think like getting beat up by your customers, getting beat up by advisors, getting your ideas thrashed, going out and taking risks, like that's hard stuff. And I think we index a lot on doing a lot of the easy things and avoiding the hard. And I did that in my my last business. I did all the times. It was grueling, the things I was doing, but it was the easy stuff. Making decks for different sales calls versus like hammering as many emails out and getting on the phone and pounding the pavement. So I think just find the hardest things possible at every single stage and index on those more than, do 3 hard things instead of 10 easy ones is kind of the thing, because the hard things compound and end up delivering, I think, the majority of the value from a growth standpoint.
That's great advice. Alex, I really appreciate you for being a guest on the Start to Scale podcast by Gilder. Amazing story. Fantastic that you're able to, go from, 0 to $250 million of, venture funding. And it sounds like you have over 9 figures of revenue at this point.
Not
So it's
yet,
no
but
small.
we're close.
Yeah, getting there. So that's amazing. Anything else you'd like to share?
No, I mean, thank you so much for having me. And I think the other thing for any founder listening is get as much information. There's, I only know what I know based on my experience in doing what I'm doing, and this kind of stuff worked really well for me. The opposite could work well for somebody else. And I think when we, you know, putting either any voice on a pedestal, you should also be taken with the context of their experience and what has worked for them. And so I think that I love chatting with founders that have done more and had more success, or the ones that are more starting out. So I either can learn or share my experience. And I encourage as people grow in their businesses, engage with others and try to explain the things that you did that worked and explain the things that you did that didn't work, and share that kind of information, because I think that's the stuff that really moves the needle for folks. So no, thank you so much for having me on. Really appreciate it. And it was a lot of fun.
Thank you so much, Alex.